Hello, we are going to talk about Chapter 26 today, which is capital budgeting. And I always personally enjoy teaching this lesson just because it usually helps students look at decisions in a new light. And you know, at the end of the day, that's really what Accounting 212 is all about. I had a student in my office last week, and he said, you know, I think what makes Accounting 212 more challenging for him was that he said for 211, you had an end goal. You knew everything was going to impact the financial statements. But with 212, because it's all about decision making, you're looking at so many different tools a company can use. And he's like, just when I feel like I'm getting the grasp of one tool, we're moving on to the next. And that's probably, you know, a good analysis of what 212 is all about, because it's all about looking at managerial decisions and what information can be used to help in decision making. We're looking at just a wide variety of different tools, so that's why we've done everything from process costing to activity-based costing or cost volume profit analysis, and it's not something you can just pull all together because we're looking at a multitude of different decision-making tools. So if you have felt like you never were able to connect everything in 212, there's a good reason for that, because not everything does connect, because once again, like I said, we're looking at different tools that can be used in a company to help management make decisions. I just wanted to share that because I just thought it was a really good analysis from a former student that had taken it. So today, we're going to be looking at another new tool called capital budgeting. And really what we're going to be looking at is when companies are trying to decide to make really large, impactful decisions. Should we build a new building? Should we, if Starbucks, should we add a new fancy coffee machine to each of our retail stores? They have to use some tools to say, well, are we going to get our money back? And when are we going to get our money back? And what's going to be the rate of return, et cetera. So we're going to be looking at those type of major decisions and looking at 3 different types of tools companies can use to help evaluate those type of decisions before they go out and build the building or buy the new coffee machine, etc. So when we talk about capital expenditure decisions, we're going to be looking at any decision that relates to investments in property, plant, and equipment. So pretty much your non-current assets. And to really do a proper analysis of these types of decisions, we have to take into account something called the time value of money. So if you haven't heard of the time value of money takes into account that if I receive $1 1 year from now, that dollar is not worth as much as it is today, because over time money loses buying power. So a company has to take in that consideration. And they also have to think about cash flows that the investment they purchase could be either coming in the future or going out because of that investment. So these types of decisions that we're going to be looking at, anything that has to do with property, plant, and equipment, they always have a really long run impact. So companies really have to look at the future. So here's some examples of companies that you may have heard of. Duke Energy. If they decided to invest in a 400 rooftop solar panel installation, they would have to look at things such as the time value of money, what cash flows would be coming in or going out in the future. Pfizer, if they invest in some biotechnology factory in Ireland. Hotel chains, if they invest in a new hotel in Moscow. If Nordstrom decides to open up a new store in New Jersey, and maybe if Starbucks invests in a new product such as instant coffee. These are the types of decisions that we're going to be looking at today and what tools companies can use to evaluate those decisions. So there's always risk when we talk about capital investments. And once again, the examples we just looked at up here is a capital investment. Things such as new technology. So what does that mean? So for example, if Pfizer does decide to invest in $294 million biotechnology factory in Ireland, they have to be able to take the risk that what if a new fancy technology comes out 5 years from now that pretty much makes everything we're doing in this factory obsolete. They have to be able to accept that risk. A long recovery period, all right? If Duke Energy puts 400 rooftop solar panel installations out there, it may take several years for them to recoup their money back. And finally, management and experience. When you're investing in something brand new, so for example, if the Loto hotel chain decides to open up a new hotel in Moscow, they have to factor in management and experience in regards to the culture, et cetera, and have to, you know, factor that in of the risk, basically. So how do companies decide to invest in an opportunity? There's two types of tools they can use. One is something called discounting methods, where we're going to look at a tool that includes the time value of money, and it's actually called the NPV, or net present value tool. And then there's non-discounting methods. And non-discounting methods will ignore the time value of money, and the two specific tools we're looking at, maybe you should just remember these, is the payback period and something called the accounting rate of return. So altogether, we're going to be looking at three new tools. When a company is looking at a capital expenditure, or AKA a new investment opportunity, they have to know a couple of things. How much cash they're going to have to pay or up front, all right, or when they're going to receive cash inflow because of the investment, and when they're going to receive it. So basically, how much and when is the money going to be coming in. Those two things they have to know before they can go forward and make an educated decision. So we're going to start with the non-discounting methods first. They're a little bit easier, so I always like to kind of build up in the lecture. So the first non-discounting method is the payback period. So kind of very self-explanatory. We're going to be looking at how much time is it going to take for a company to get their money back. Just looking only at cash flows. Seems like a very reasonable request. A company's definitely going to want to know that. And so, of course, the focus is going to be, hence, on cash flows. So let's just take a look at one of these problems. So say below is a cash outflow and inflow information for two potential investments. So we have Project A and Project B here. Project A has parenthesis signs. So this means up front, year zero, so basically when we take on the investment, we're going to be spending $240,000. So parentheses is always going to indicate cash outflow. Then year 1 through 5, we're going to get cash inflow of $50,000 because of this investment. Project B, the initial, when we first purchased the investment, we're going to spend $180,000. Once again, that indicates the negative. And then each year they're going to receive a different amount of money coming in. So question 1 asks, what is the payback period for Project A? Well, when we're dealing with the same amount of cash inflow that's coming in, and it's the same amount year after year, the formula is very simple. We take the investment divided by the annual flow. So in this case, we have an investment of $240,000. We have an annual cash flow coming in of $50,000 each year. So this tells us in 4.8 years, we will break even. So not too bad, right? The next one, still not too difficult, just can't solve it quite as easily. We kind of have to use more of a just plain old adding and writing on a piece of paper. So what's the payback period for Project B? So Project B, they spend $180,000. So we want to know when will we recuperate that $180,000. Well, we can't use the formula because the cash inflow for the next 5 years is a different number. So we just have to do some good old simple adding, friends, till we hit the $180,000 mark. So if I add up year 1, year 2, and year 3, I'm at $150,000. So not quite there, we're about $30,000 short. Year 4, we'll hit that. We'll actually end up receiving $40,000, but we only need $30,000. So I can't say 4 years because that's not necessarily accurate, because in 4 years I will have more than $180,000. I want the exact amount of time. So, and this is assuming that this cash flow is coming in evenly throughout the year. I need $30,000 of that year 4 of $40,000 coming in. So if I take $30,000 over the $40,000, I get 0.75. Therefore, it's going to take me the first 3 years and 0.75 of the 4th year. So it's 3.75 years to get my money back. So payback period, what are some of the uses and limitations of it? The nice thing is it's kind of a good screening tool. So if a company is looking at a lot of investment decisions and they first just want to kind of, just throw out the weakest ones, they can use it as a screening tool of just kind of initially getting the list narrowed down. It is a very good tool if a company is very concerned about cash flow. So for a lot of startup companies, cash flow is the #1 concern. Some negative things about it is that it does ignore the time value of money, and the total return is never talked about. So for example, when we looked up here, we talked about how many years A and B it would take to get the money back, but we never looked at how much total money are they going to receive. So let's look at another example. Canon Incorporated is considering 2 projects which both cost $50,000. The expected cash inflows from the projects are as follows. So for investment 1, we have a total of $55,000 that's going to come in. All right. So we'll look at investment 2 here in a second. So using the payback method, which investment should be chosen? Well, both cost $50,000. Investment 2 will only take 2 years to get the $50,000 back, while investment 1 will take almost 3 years. So investment 2 looks like the best option when we're looking only at the payback period. But what about if I talk about total return? Which investment is most desirable? Well, if I look at total return, well, investment 1 is the best option because they're going to get $55,000 versus $50,000. So it just shows how kind of the limitation on the payback period. If we were only focusing on when we're getting our money back, we would choose investment 2. But, a company may say, well, for just having to wait, half a year longer, we'll get our money back and we'll get more money. So that's why you just can't usually only use one tool to make your decision. You have to kind of look at the whole picture. But that's payback period. Not too bad of a tool at all. The next one is accounting rate of return. Now, a lot of times this is also just known as the return on investment as well. But basically, what it's going to do is going to compare the income we're looking at to the total investment. And so we're going to use the corporate method. There's a couple of different methods to do the accounting rate of return. And the reason why, there's some methods out there that differs depending on kind of what the company's overall goal is. But we're going to use the accounting rate of return. Well, we're going to use the formula. We're going to take our average accounting income. So when I'm talking about income, I'm talking about net income profit divided by the total investment. All right? So let's look at an example here. We have Brown's Corporation uses the ARR method to evaluate investments. A capital investment they are considering has an initial investment outlay of $250,000. The life of the investment is 4 years and is expected to produce net income as follows. What is the average accounting income? So this is the net income. So if I was wanting the average accounting income, what I would do is add up year 1 through 4. And if I add them up, that's where I came up with this $150,000. Then I would divide by 4, because we're looking at 4 years. And this tells me my average net income every year, or average accounting income, is $37,500. And then question 2, what is the ARR? So we're going to be going back up here and using this formula to calculate that. So my average accounting income, I'm going to see if I can zoom out here a moment. Average accounting income, the first part of the formula, is $37,500. Then I'm going to divide that by the investment, which is up here at $250,000. So that gives me 0.15, or also equals 15%. So why would a company do this? A company would do this many times. A company is going to have a set percentage that they say any capital expenditure, any investment that we decide to move forward with has to have an accounting rate of return or a return on investment of X amount percent. So a lot of times you see companies that say it has to have a 10% or 12% rate of return. So the company would estimate the potential investment's ARR, and then based on that, if it hits what the company seeks. So if this company said we have to have a 10% rate of return, all right, this project will hit that and more. So it's still in the mix of investments to decide from. So that's why the accounting rate of return is used. Pretty much to see, does it hit the company's benchmark standards? So now let's move into the discounting methods. The discounting methods, we're going to look at net present value, or NPV. And what we're going to be doing is looking at future cash inflows and outflows and calculating that future money either coming in or going out, what is that worth in today's dollar term? So before we move into this, let's talk about just some facts. It is better to receive $1 today than any time in the future because, as I mentioned in the beginning of the lecture, $1 today is going to have more buying power. You remember, right, I heard my parents say, I remember we could buy a bottle of Coke for, 5 cents. Well, that 5 cents back in the 1950s had higher buying power, right? It was worth more then than 5 cents is now. You cannot buy a bottle of Coke for 5 cents now. Another fact, $1 received today can be invested to grow to more than $1 in the future. And companies invest money today hoping to receive more money in the future. So with that in mind, we're going to be looking at net present value. And once again, what our goal is here is to take future money that we're going to receive or future money that we're going to pay and say, what is that worth in today's terms? So we're going to be looking at cash inflows and cash outflows. Let's look at some examples of what would be considered a cash inflow. One would be incremental revenue. So what does this mean? So Starbucks decides to invest in a new fancy coffee machine that's going to make, this new fancy coffee. All right, the additional revenue that they would receive from that coffee, from that new coffee machine so they can sell their new product is incremental revenue. Now, we wouldn't take in consideration the revenue that they make on the drinks they currently sell, just the new drink because of the machine. Cost savings, all right, if that coffee machine was able to eliminate an employee's, so therefore eliminate employees' wages. We will look at the cost savings that's just attributed to that coffee machine. Maybe any tax savings and residual value. So if you remember back to your H11 days, residual value, salvage value, etc., is when we say, all right, when we're done with this coffee machine in 10 years, we think we'll be able to sell it for X amount of dollars. So we want to take that in consideration, and that would be an inflow because that would be money we would expect to receive in the future for the coffee machine. Then outflows would result in the actual price we pay for the investment and for any operating costs, if we had maintenance costs in regards to the coffee machine, etc. So let's talk about some rules for calculating net present value. When we do cash outflows, we're going to show them as a negative. Cash inflows are positive. So very similar, right, to your cash statement of cash flows. We only want to look at incremental cash flows that's associated to the actual investment. All right, so as I mentioned earlier, if Starbucks bought that new fancy coffee machine, we would just look at revenue attributed to that. We wouldn't look at revenue for all of their products. Any cash flows that's already been incurred are considered a sunk cost and they're not relevant, all right? Now, to do this, it's going to be very important to use a resource in your textbook, all right? You're going to want to use Appendix B in your textbook, and I'm going to flash that open here in a second. So if I look at the Pearson e-text, excuse me, Appendix B, the first table says present value tables. You're going to need to maybe put a little sticky tab or something here, sticky note. We're going to use table B1. It says present value of $1. So we're going to use Appendix B, B-1, and we're also going to use Appendix B, B-2, the present value of an annuity. So those first two tables you will have to use in order to complete these problems. All right? So let's just start out with a simple problem. What is the present value of $1,000 received 5 years from now if your required rate of return is 12%? So what does this 12% mean? This means that I could go out into the market, take this $1,000 and invest it today and know I could get 12% return on it. All right, so either in the stock market or some type of interest, etc. So you always have to be given the required rate of return. So what I would do, I'm going to type in $1,000 here. Because I'm looking at just a single dollar amount, all right, I'm going to use, if I go back to the table, I'm going to use table B-1 that says present value of $1. This means we're looking, you may want to write this on, as a little note for you on your book, we're looking at the present value of a single sum. So we use this table when we're looking for a present value of a single sum. Now, I wish there was many that I could flip this table, but I had played with it earlier and there's no way that the e-book will let me. So hopefully you can still follow along. So what I'm going to do, I need to find a factor in here. These are all factors, present value factors, to multiply that $1,000 by so I can find out what is that $1,000 5 years from now, what is that worth today. So the required rate of return is 12%, and I'm looking for 5 years from now. All right? So what I'm going to do, I'm going to go down to periods and see where it says 5 right here. Okay, that's where I'm going to begin. And then I'm going to scroll over and from 5, I want to scroll all the way over till I hit the 12% column. And I hit the 12%. So I'm in row 5, 12%. And it says 0.567. So I'm going to take that 0.567 and put it in my formula. So once again, I went to row 5 because it's 5 years, and to the column of 12% because we require a 12% rate of return. And I see the number here, 0.567. So I'm going to take this $1,000 times 0.567, and that tells me that $5,000 5 years from now is worth $567 today. And that's assuming I could take that $567, put it in an investment, and get 12% return. So that's kind of a simple one. So let's look at a little bit more in-depth one. So we have a 4-year investment opportunity. The initial cost is $50,000. We're going to have annual incremental cash flow of $22,000. So every year, $22,000 is going to come in. We have a residual value of $8,000. So at the end of the 4 years, we're expected to get $8,000 back. And the required rate of return is 14%. All right, so the company says we have to have a 14% rate of return. So how we're going to do this is we're going to look at inflows first. And what we're going to do is list each of the inflows that this investment will produce in. All right? So the first inflow, money coming in, is going to be the cash of $22,000 that we're going to receive every year. Okay? Let's go down to the next one. And the next inflow is going to be that residual value of $8,000 that we're going to receive. So these two, highlighted in yellow, are the inflows. So we have those listed. Now, because this cash is $22,000 coming every year, we call that an annuity. When money is going either in or out every single year at the same dollar amount, that's known as an annuity. So that's why I wrote that down here, and it is going to come into play in a few moments. So now what we want to do is take this inflow, $22,000, that we're going to receive for the next 5 years, next 4 years, and say, what is all of that money worth today? What is that $22,000 in every year for the next 4 years? What is that worth in today's terms? So what we're going to do, we're going to go to that table, Appendix B. But now when we go to it, we're going to go to the table B-2. And the reason why I'm using the table B-2, because it says present value of an annuity. I use this table when I'm looking to find the present value in today's terms of money that's going to happen every year in the future. So it's happening multiple times. It's not just a one-time dollar amount. Now, we're going to go to period 4 because this investment is 4 years. And we're going to go over to the column 14% because the problem says required rate of return is 14%. So period 4, so we're going to scroll on over. And at 14%, period 4, the factor, the number I need to write down is right here, the 2.914. So write that number down, because what we're going to do to turn that $22,000 into today's terms for the next 4 years, we're going to take $22,000 at 2.914, that dollar amount we just found right here, and that comes to $64,108. So that $22,000, that's going to happen for the next 4 years. So write $22,000 in over 4 years is a total of $88,000. So that total of $88,000 we're going to receive in the future is worth today at $64,108. All right? We also need to do the same thing with that $8,000 present value amount. But this residual dollar amount of $8,000, this is only going to happen once, and it's going to happen at the end of the 4 years. So because this is a one-time dollar amount, I'm going to use table B-1, the first table, because it's a single dollar amount that's happening once. So let's go to the table B-1 where it says present value of $1. We're going to go to period 4, scroll over to column 14%, and we get a number that's 0.592. So we're going to multiply that $8,000 times 0.592. And that gives us $4,736. So that $8,000 4 years from now is worth $4,736. You'll notice all of these numbers are positive because they're going to be future cash inflows. So we have turned the cash inflows of this investment into what is worth in today's dollars. Now we're going to look at outflows. So the only outflow we have is the cost of the investment of $50,000. Now, the cost of this investment is happening now. So when I do the present value of it, because it's happening now, it's already in present value terms. That $50,000 I'm paying today is worth $50,000 today. All right? So you only use present value if the money is happening in the future. So I'm going to put parentheses negative $50,000 to show it's an outflow. And then the final thing I'm going to do is now I'm going to calculate the net present value. So what I'm going to do is come over here and add together or net together the positives and the negatives here. So I have $64,108 plus $4,736. These are all positive numbers because they're going to be future cash inflows. And then I have a negative $50,000. So the sum of that comes out to a positive $18,844. So what does that $18,844 represent? That represents that in today's dollars, once we pay for the investment and look at the future money we're going to get, all of that in today's dollars, we would have a surplus of $18,844. So should the company accept or reject this proposal? Based on this, they should accept it. And I'm going to show you the rule of thumb. The rule of thumb is that if your net present value is equal to or greater than 0, you accept the investment. If it's less than 0, you reject. Now you're going to notice it says here equal to or greater than 0. And you may be thinking, why would any idiot accept an investment at 0? What all that 0 means is that the future cash flows is still going to cover their costs. So they would break even, all right? So they would not be losing any money. Let's do another example. So now we have an auto repair shop. And I'm going to just, let's hide these for a second so you don't get distracted. An auto repair shop is considering the purchase of an automated paint spraying machine. The machine will last 5 years. Following information is available. Each year, $2,000 will be saved on paint. It will reduce labor costs by $20,000. It will require a maintenance cost of $1,000. The machine costs $70,000. The expected residual value is $5,000, and the required rate of return is 12%. So before we start diving into this, let's just, since there's a lot of numbers here, let's just go through each one and label it as an inflow or an outflow. So each year, $2,000 will be saved on paint. Because we're saving money, savings is always an inflow, because that's going to be cash we are going to have now that we wouldn't have had. It's going to reduce labor costs by $20,000 each year. Because it's a savings, that's going to be an inflow as well. It will require a maintenance cost of $1,000 each year. That's going to be money going out, so that's going to be considered an outflow. The machine costs $70,000. That's going to be an outflow. And the expected residual value is $5,000. Remember, that's the amount of money we expect in the future that we'll be able to receive. That's an inflow. So here we have 3 inflows and 2 outflows. So let's look at this problem. So first we're going to look at the inflows. And let's just list the inflows first. We have the paint savings. We will have the labor savings. And we will have the residual value. All right? So now let's go over and calculate the net present value of each of these 3 items. So for the paint savings, this paint savings is every year, each year. Therefore, because it's a savings every year, when we do this calculation, we will have to use table B2, all right? So let's go to the table. So I need to go to the appendix B-2 table where I'm looking at the present value of an annuity of $1. Remember, any dollar amount that happens over and over is an annuity. We are looking for a 5-year time period here and a required rate of return of 12%. So let's go to the 5-year row, and then we're going to scroll to 12%. So 5-year at 12%, the value we want here is 3.605. So when we're calculating the present value of that paint, I'm going to take that $2,000 times 3.605, and that gives me $7,210. Remember that $2,000 is each year. So $2,000 of savings over the next 5 years is $10,000. But that in today's dollar is just $7,210. All right? Labor savings, because labor savings is each year, we're going to use the table that we just looked at, the present value of an annuity. And the figure is going to be the same amount. We're going to use the 5-year row and scroll over here to 12%, so we're going to use the 3.605. So we would take the 3.605 times the $20,000, so that money in the future is worth $72,100 today. All right? And then we have the residual value, which is $5,000. This is a one-time dollar amount that's going to happen at the end of the 5 years. So because of that, we need to go to table B-1. We need to look at the table, the present value of $1. All right? Once again, we use this table when we're looking for a single dollar amount. So we'll look at period 5, scroll over to column 12, and the factor we're going to use is 0.567. So we're going to take that $5,000 and times it by 0.567 to show us that $5,000 in the future is worth $2,835 today. So at this point, we've taken care of all of our inflows. So now we just have to worry about outflows. So the outflows we have above is the maintenance cost and the machine cost. We got two of them. The maintenance cost is going to be $1,000 each year. So we have to turn that $1,000 we're going to spend in the future in today's terms, and it's going to happen each year. So because it's a future amount, we have to use the table, and because it's going to happen each year, we're going to use the present value of an annuity table. So we use these tables for cash inflows and outflows. So I'm going to go to year 5, row 5, scroll over to the 12% column, and use the factor 3.605. So I'm going to take that $1,000 that's going to happen each year times 3.605, and that's an outflow. So I'm going to put parentheses around that. And so that $1,000 we're going to spend for the next 5 years is going to be worth, in today's terms, the equivalent of us spending $3,605. Now the machine cost, that dollar amount is happening today. Just trying to see what happened here to my... So that $70,000 for the machine cost, that's going to occur today, all right? So now I want to calculate my net present value. All right, so let's get out the little calculator. So we're going to add up the 7,210, add up all the inflows first, plus the 72,100, plus the 2,835. Then we're going to subtract out the $3,605 and the 70,000. So our net present value is $8,540. So once again, what does that mean? If I look at everything I'm going to spend and all the money I'm going to receive, the surplus in today's dollar terms, the surplus is going to be $8,540. So would we accept this investment? Absolutely, because the net present value is greater than or equal to 0. All right, my friends, that is the Chapter 26 lecture. And I believe this is going to be possibly maybe the last chapter. I haven't decided. I might be cutting one. Anyway, I have enjoyed being with you guys by recording these lectures. I hope they've been helpful. I want to thank you for your hard work and dedication and willingness to listen to these lectures. I know it's more extra time consuming, but I really do think it helps the grades and that your grades are benefiting from them. Anyway, please always feel free to stay in touch. I love staying in touch with my students and hearing about how they are progressing in the future. And before I forget, let's do the final, well, possibly final attendance phrase for this lecture. Let's do the attendance phrase of the week, which is going to be LAMP, L-A-M-P. All right, have a good one, and I hope to talk with you soon.